Good morning, everyone. Welcome to Weekly Profit Talk and happy tax day. That's right. Today's April 15th. Another tax season is in the books, and I hope you're as happy as I am. I just couldn't be happier. Good morning, everyone, and welcome. Happy Wednesday. Today's topic is tax related, as you would think it'd be appropriate for the day. Let's and our topic is the post-filing debrief, what your 2025 return is telling you. I am assuming that you've completed your tax return by now. Today is the deadline. If you have not filed your tax return and you've completely forgotten about it for some reason, and you happen to be watching this and like, oh man, and pop yourself in the forehead, uh, then you need to do something called an extension. Okay, now an extension is only an extension to file. It gets you out of the penalty for failure to file, but you do need to make some kind of payment with it if you believe that you owe money. I am actually, well, I'll just tell you, if you need to file an extension, it's as simple as going online and typing uh, IRS extension 2026 into your search engine. You're going to see a hyperlink for something called Form 4868, and that's the extension for the Form 1040. Now, the one for your business return, if you're an S corporation or a partnership, should have already been done before March 15th. That's also a different form number, 7004. 4868, all you have to do is basically print the first page and cut off the bottom of it and mail it in. The fourth page of that PDF will give you all the addresses depending on where you are in the country. Get one done. Okay. Let's move on to today's topic. What is your 2025 return telling you? And let's go ahead and I'm going to share the screen here. The numbers inside the numbers. Uh, most practice owners, and I'd say most business owners in the country that are entrepreneurs and have to file some kind of business taxes, get a quick look at the refund of the balance due, and they move on without thinking about what the valuable tool the tax return is for them. And I just want to spend a few brief minutes talking about that. So, one thing is if you have decent software at all, or your tax preparer does, you should have a page called comparison, and it will show your previous years. But at the bottom of that, you're going to have something called your effective tax rate. Now, this is a percentage, and you get this by dividing your total tax by your taxable income. Uh, Doctors basically range effective tax rate anywhere from 17 to 24%, or you could be higher if you're making seven figures a year, certainly. But that effective tax rate gives you a lot of information. For one thing, if you're married and your spouse is working a W-2 job, they should be withholding somewhere near that effective tax rate from their paychecks every pay period, be that twice a month or whatever. Under withholding can cause you to pick up the burden of that in estimated tax payments. So it's important to know your effective tax rate. Uh, that is a very valuable number, and people kind of forget that it's in their return. Now, another thing, as you are a specialized service, trade, or business as a doctor, so am I, accountants, musicians, and some other fields, architects. So we don't get all the qualified business income deduction past a certain income limitation. Okay, I want to go over that a little bit. Let's say, for example, that you are running a practice and your total income for the year is over the phase out and furthermore, in our example, the married filing joint phase out for the qualified business income deduction is for people with adjusted gross income of over $544,600. That starts phasing out 150,000 below that, or 394,600. So what that means is if you make over $394,000 in adjusted gross income, um, and it's from one business source, chances are that you're not getting the full 20% deduction. Now, here's the thing to keep in mind. If you have multiple business endeavors, um, as a physician, as many of you do, you may do locum tenens work and get 1099s from people. That is a separate business endeavor, and that quite possibly can be uh, qualifying for the entire 20% deduction. So you may find that you're able to get it from portions of your total profession, in other words. So, if that's not the case and you're basically focused on one practice exclusively, keep an eye on that. Now, the theory is, and this is the IRS basically being our nanny here, is if you're making over 544,600, you don't need a qualified business income deduction. Personally, I think that's crappy and I don't like it, but it's a thing to keep an eye on. Okay. So I just want to bring that to your attention. The path of breadcrumbs. If your estimated payments were wildly off, either you underpaid or overpaid, it suggests that you weren't following your income patterns last year. And you basically, one of the tenets, the core principles of the practice that I have and what we do for our clients is to take a look at performance each and every quarter. So we understand you're doing something that's basically saving lives and making the lives of your patients better. You need to focus on your zone of genius. So it's understandable if you're not following this, but um, if you underpaid taxes by five or $10,000, you're going to have a box at the bottom of your 1040 that shows a number called underpayment penalty, and that's added to what you owe. So you want to pay your tax expense as you go the four times a year that's required: April, June, September, and January, on or around the 15th, depending on if it falls on a weekend. It keeps the room in your mind clean. You're basically paying into the tax system at the same pace that you're making the money, and you should not owe more than $1,000 to either the federal government or whatever state you're in if you're in one of the 41 states that has a tax. So, um, estimated payments that were wildly off need a good hard look. Reasonable compensation. Now, this is for U.S. corporation owners, and I would venture to say that's probably going to be quite a few of you. You are basically required to take a wage first from your business, and it needs to be reasonable. And what that means is it should be the lesser of a little under half of all the money you make, net income plus wage, or if you have sufficient income from your practice, the amount that it would take to replace you uh, with somebody of equal qualification. So if your reasonable compensation is the same after 3 years and it's not going up, but your net income is, huge red flag. People actually are called into tax court and penalized for not paying enough FICA tax through the mechanism of taking a reasonable compensation. Retirement contributions. If you had the money and you fell short of available limits, you left tax savings on the table for one thing if you do traditional before tax contributions. But the other thing is that you're not maximizing your potential retirement to the best of your ability. So that's another thing to take a look at. Further, if you got a refund of five or $10,000, this is not a win. What happened is that you just provided your government, be they federal or state, with an interest-free loan. They got to spend your money all year, and then they're giving it back to you with absolutely no interest accumulation consideration. So, large refunds are not good, actually, and that's why I would like to target our clients' practices so that they are either paying less than 1,000 or getting a refund of less than $1,000. And that's a wide window if you are calculating based on performance each quarter. Okay, so, oh, sorry, I jumped a little too far. So looking forward, what do you do? Are you going to calculate your estimated payments each quarter based on your practice's actual performance, or just keep recycling last year's numbers and hope for the best? This should be an obvious answer. Are you going to revisit your entity structure, your compensation, your retirement contributions, or let another year pass on autopilot? The practices that build wealth aren't the ones that file and forget. They take a look at their return and they debrief on them. So, what might that look like for your practice? Let's talk about that for a brief moment. If you're interested in doing the kind of uh, practice work where you have someone that is basically your guide, your Yoda, as it were, for your financial situation so that you're able to focus on uh, the practice of medicine, and you're interested in learning more about how that looks for you and your practice, and possibly saving tens of thousands of dollars every single year. In fact, we could almost guarantee this, okay, depending, of course, on what your current entity structure is. If you are interested in knowing about that, we're coming to you live on One of Three Media. We're on LinkedIn and YouTube as well as Facebook. So all three of those have a comment capability. Pop in there and say help or more info or let's talk or be creative, say something. We'll get back to you within 24 hours if it's during the week, and we will set up a free call with me personally. So if you want to talk, let's do that. We've got the basically the second trimester of the year starts with the end of April, and it's a good time to crank it up and really go for a high fiscal performance. You can do that and do the good moral and righteous work of being a healer as well. It's possible to do both, and that's why you spent 10 years in school and training. So with that, I hope you are having an amazing tax day. You've got to know I am. So, with that, enjoy the rest of your Wednesday and the week to come. And if you have a chance today, do something randomly kind for a stranger. So, until next week, Wednesday at 8:30 a.m. Mountain Time, sorry, we will see.